Welcome back, guys. In today's episode, we'll be reviewing SCHD and the dividend machine that it currently is. And at the end, I'll be telling you my future plans on investing in SCHD, so stick around. Alright guys, so I want to start off with just a quick portfolio update. We're currently sitting at $318.30 and we've lost $2.06 since we started this portfolio. Let's take a quick look at our current holdings, and for those of you who are new or don't know what we're doing here, we're investing $10 a day into high quality dividend growth stocks, and you can see here that we are currently invested into SCHD, which we're going to talk about right now. So what is SCHD? SCHD is a U.S. dividend equity ETF, and it tracks the total return of the Dow Jones U.S. Dividend 100 Index. In order to get into SCHD, you have to have paid dividends for each of the last 10 years. So they do have quite a standard when it comes to their holdings. And now what people love about SCHD is obviously its dividend. Guys, this dividend yield is pretty crazy. 3.48 dividend yield, and the expense ratio is fairly cheap at 0.06%. Now, what I want to look at next is their dividends. Everybody loves this ETF because of its dividends. Let's take a quick peek at their dividend growth. Now, over the past 10 years, their dividend has increased immensely. Look at this. It skyrockets upwards. And that's what I think at the end you'll see why I'm a little hesitant on this one. But let's keep going. And what I think draws everybody into this is the 10-year return. They see this 11.67, and it's right there with the Dow Jones U.S. Dividend 100 Index, and it's even above the Morningstar large value. But what I think draws a lot of people into this, I'm going to go over to this investment calculator. So if you started at $0 and you just invested $100 each month, over 10 years you'd have $21,811. That is quite the gain on just one ETF, but I just don't think that's realistic. A lot of people keep saying, oh, it's going to be 11.67 forever. Guys, it's never even faced a really tough time. So I think a more realistic return is 8%, but that's still bringing you to 18 grand, $100 over, a 12-month period, and you do that for 10 years. So I still do think that this is an incredible ETF, especially for dividend growth. Now, their top holdings, these are their top holdings. Guys, you know all of these companies. These are like America's sweethearts. Home Depot, Cisco, Pepsi, Coke, Texas Instruments. I love Chevron. So I think these are all really good companies, especially Broadcom. They've had just huge growth over the past 10 years. So I really like these. But what I find to be interesting about this is just their sector weightings. They are really heavy when it comes to the industrials. They're over 18% in the industrials. They're over 15% in healthcare. And they're over 15% in financial services. So why is that interesting? Well, that's interesting because all of these sectors, they tend to be pro-cyclical. Now, what's pro-cyclical mean? That means that each one of the companies within these sectors, their profits increase, but that's usually with a growing economy. So if you look at what everybody has been saying for the U.S. economy, they say, oh, the U.S. is likely headed for a recession in end 2023 or early 2024. This was written on July 24th. We can go over here. I just typed in recession 2023. You'll find an article every day. They've been talking about a recession forever. So if we do end up in a recession, I don't think that this price right here, 74.54, I don't think that it'll stand near there. I think it's really going to take a big crash. Over the past 10 years, you can see one of the lowest points that it's been. It's really been since inception. Well, inception, I think, was in October of 2011 for this, but for this point, it was at $33, August 12th, 2013. I think it could go even below that. Now, that's interesting because that's a point where I'd be buying. I would be looking to scoop up all the shares, as many as I could, for the cheapest price possible for SCHD, to accumulate as many shares as possible. Now, that would make most sense because then you'd see this increase when a bull market would arrive or the market bounces back, and you'd get your growth back, but it's also going to be paying you a really good dividend. So I think that's what my plan in the future will be. Right now, you can see I only have $48 in SCHD in this portfolio. Guys, that's not even a full share. So I'm going to keep investing into SCHD. You can see I have them targeted for 16% of my portfolio. I think it's reasonable. I don't see any reason for me right now investing $10 a day. I don't see any reason to pull back off of SCHD. But when I do think of, what the financial future is going to look like, and I see, maybe we could have the possibility for a recession come late 2023, early 2024, I might set some money aside and go ahead and pick up a handful of shares, as many as I can accumulate of SCHD. And I think that's what's going to end up paying me the biggest growth profit at the end. And they're going to say that that's the best value. $33 is a really good value for SCHD. If you could get SCHD for $33 today, you'd be jumping and screaming. But, just food for thought. And I think that's what I'll be doing in the future. And you guys can go ahead and tell me what you're going to do, what your plan is for SCHD if you invest in SCHD. And let me know if a recession hits, if you'd be scooping it up or if you're going to totally avoid it. Because, like I said, I really like these companies. I don't know if these companies do well through a recession. I think a couple of these companies do just well enough, like Home Depot. I think they'll do just well enough. Cisco, Pepsi, and Coke. I just don't know if the rest of these companies will really do all that well in a recession. So I think I'll definitely end up scooping them up, but I don't know if they'll be able to keep that stock at 75, even above $60 when a recession hits. So that's my plan. All right, guys. Thank you.